everybody to a new webinar from LPX on private equity benchmarking. Today I would like to talk about valuations of private equity investments and how you can overcome the biases that you have when benchmarking and comparing the performance of private equity funds with the broad private equity market. But first of all, I would like just to summarize the needs and benefits of benchmarking private equity returns, and especially when you look at the limited partners and also at the general partner level, what type of use cases we see in order to make reasonable and adequate performance benchmarks, and how to compare your performance with a broad private equity market. First of all, when we think about the LPs, the limited partners, of course, there is a need to compare the fund returns that a limited partner gets from investing into private equity funds. He wants to know, well, what is the alpha generated by the fund manager? What over return can I expect from the fund manager, and how does this compare to the broad private equity market, assuming that the LP, that the limited partner, is invested in a very broad and diversified private equity portfolio. Then we see use cases in the asset allocation. In the asset allocation, an investor asks how much he should invest into an asset class, be it global stocks, be it real estate, be it bonds, or how much should I allocate to private markets, to private equity. And you need reliable data, you need transparent data in a similar way for all of the asset classes in order to make an adequate performance measurement and an adequate calculation of how much you should invest into each of those asset classes. When it comes to monitoring and compliance, we see more and more requests and also regulations that the regulators also require investors that publish performance reports but also from the manager side that provide performance numbers on private equity investments. Regulators, in the meantime, require more regular updates on the investment portfolio level. We just had this announcement by the SEC. So there is a trend to more standardized reportings also for private market investments. From the GP side, of course, the GP wants to show his performance. However, when you think about a first-time fund manager that is just raising his first fund and does not have any track record, he needs to show the performance of the asset class as a whole. And again, here it is important to compare the performance of private equity with other asset classes, but you need here adequate performance numbers and data that is reliable and can be compared with other asset classes. And that is a problem with the existing data sets you have for private markets. You simply cannot compare those performance numbers. Internal rates of returns, for example, cannot compare to the performance numbers, to the return numbers of a traditional equity investment in global stocks. Also, reporting is a topic here. Regulators require also the GPs to come up with reliable reporting numbers on their fund investments that can be compared within the asset class, but also with other asset classes. As most of you know, there are some biases, and that's our main topic of today. Some biases when you think about investments and performance measurement of private equity investments. One very important bias is the so-called self-reporting bias. That implies that a fund manager that is providing performance numbers of his fund that he is or that the manager is managing. Of course, there is a interest to show good performance numbers, and there is always an interest to be in the top quartile of the performance numbers. However, as everybody knows, not everybody can be in the top quartile. So, of course, there is from the investor side always the question: how reliable is the data, and how can I challenge the performance numbers that I'm being presented by the GP? For those GPs, for those fund managers that are launching a first fund, they need performance numbers for the asset class as a whole because they don't have a track record. So here, the GP has the problem. He has to choose a benchmark that shows a very good performance. And then the question is, what kind of data is he using here? And what we see in many cases is that performance numbers are presented which can simply not be compared to other asset classes. So the question is then how meaningful is the performance numbers that you get from a GP that is raising his first fund. So there are those biases. The question is, how can we overcome those biases? And before I come to that point, just summarizing again here what type of benchmarks we currently see in the market. We see mainly three types of benchmarks, three types of data sets that are used to compare your performance in private markets to the general private equity market. First of all, the private equity composites. We define private equity composites mainly private equity data that is based on cash flow data or book value data. And of course, the data is appropriate because the data is basically reflecting the underlying private equity business model. However, the problem that we see here is that the data, first of all, is not updated on a regular basis. As mentioned, there is in the meantime a requirement from the SEC, for example, to come up with at least quarterly performance updates, but that's the best you can get. You can get quarterly updates, but still for many cases, especially for the existing funds, this requirement is not applied. And for existing funds, in many cases, you only get an update once per year or maybe once every 6 months. So there is a time lag, and there's a significant time lag. So when you would like to know how would my private equity portfolio be valued as of today, it would not be that easy unless you have someone who would like to buy your existing portfolio. But otherwise, it's difficult to get reliable data on a daily or more timely basis. What you also see is that investors or GPs just use a public market index that can be a small cap index, that can be a global equity index, and that add a premium to the return numbers of that index. And of course, you have measurable data, you have timely data. However, it is not appropriate data because when you think about a global equity index or a small cap index, the companies included in those benchmarks, in those indices, are not active in the private equity market. Just because you will find a time period where the returns maybe are similar to private equity returns, that does not mean that on the long term you can expect a similar return pattern as for private equity investments. So here you have measurable data, timely data, but not appropriate data. That's also true for the third benchmark, absolute return numbers, where you just use an absolute return number, But yeah, and by definition, this cannot be appropriate for private equity investments because you simply use a return number, and you solve the problem that you have, that you don't have measurable and timely data for private equity investment, private equity composites. However, you have the problem that it's not appropriate. So the issue is that either with the existing benchmarks, you either have appropriate data or you have measurable data. So you cannot have both characteristics solved at the same time. So the question still is, how do we solve this problem? When we started with our indices 20 years ago, we started with the so-called total return indices, which measure the performance of private equity companies that are traded on the stock exchange. And just to be very clear on that, we started measuring the stock price performance of those private equity companies. So it gives you basically supply and demand on the stock exchange on private equity investments. However, it does not reflect the underlying investment portfolio performance. But nevertheless, the indices can be used in many ways, but this alone does not solve the problem that I just mentioned before. However, we have for every index, we have three types of versions. We have started with the market price indices, which measure the performance of the stock price of those private equity companies that are listed on the stock exchange. But in addition to that, we also measure the underlying investment portfolio by analyzing the so-called book value or the net asset value of those indices. And the book value or the net asset value is nothing else than the fundamental performance of those private equity managers that are listed on the stock exchange. And because they are listed on the stock exchange, they have much stricter rules, much higher regulation, much stricter governance also. So a private equity manager that is listed on the stock exchange must provide on a regular basis portfolio updates, investment portfolio updates, but between those reporting dates, they also have to announce any significant events. So in case they make a significant exit, they sell something, or they make a new investment, or there's a significant revaluation, they usually have to publish this information because they are listed on the stock exchange. And you have much stricter rules here than compared to the rules a fund manager is obliged when he is managing closed-end private equity fund. Of course, he has to report to his investors, but he is not required usually to report to the general public as a listed stock has to do. So we have those net asset value indices which measure the underlying fundamental performance. And when you compare the stock price of a private equity company and its book value or its net asset value, the stock price can either be above the book value or it can be below the book value. When the stock price is above the book value, you have a premium. When the stock price is below the book value, you have a discount. So that's our third index series for each of our private equity indices, with a so-called premium discount index, which measure the difference between the market price and the net asset value. For each of the indices, we have not only those three versions that I just have mentioned, we also have several style indices, we have several regional indices. For example, very important are the buyout and venture indices, because buyout and venture being two different subsegments of the private equity market, of course, behave significantly different especially when you look at the risk and return numbers. I will show you the example later. So we have a whole index family, and for each index, we have those 3 types of measurements. The question is now how to come up with the data, how to collect the data, what we basically do is we look at the investment portfolio, we look at all of the publications, at all of the press releases. So whenever a news comes out, we take that news and include it in our database so that we have an up-to-date and in the end, we have a daily update of the investment portfolio. So we don't wait for the next annual report or the next quarterly report. Whenever a news comes out, we include that in our database. Just to give you one example, HG Capital Trust is a listed private equity company listed in London, and they, for example, invested into Visma. And here you see on the right-hand side the valuation of that investment over time. And this is exactly what I mentioned before. So the investment was done in 2008, and then there were some revaluations, there were some new investments, new investors. So you always have over time a new update on the valuation. So they just don't keep it at cost. They revalue whenever there is an event to revalue this investment. And this is included in our database. And this then in the end gives you the performance number, in this case for Visma, then you aggregate it, then you have the performance, the fundamental performance for HG Capital, and then you aggregate all those listed private equity stocks, and then you have the performance number on the investment portfolio level for the overall private equity market. And here you see some more examples. What I would like to show here is that between those official dates, you have events, and those occur not on a regular basis. So whenever an event occurs, there is an event, and this is then immediately included in our database. And by this, we are able to have a daily update on the investment portfolio level. Of course, there are not hundreds of deals every day. However, there are some deals, and they are included in the database. And by aggregating that over a few hundred of listed, or roughly 100 listed private equity stocks, then you have a few thousands of underlying investments. So a very broad and diversified investment portfolio when you do this look through, which gives you an indication of how the market performs over time. And to give you an example, here I have 2 indices, buyout and venture. And just to be clear on that, we are here looking at the book value performance, the NAV performance, not the stock price performance. And here you see the performance numbers. So let's look over the past 10 years. You had a return of roughly 10.8% annualized for buyout investments and 7.9% on an annual basis for venture investments over the past 10 years. So as you can see here from the chart on the right-hand side, you see venture in blue against the buyout index. Of course, there are significant differences in the return numbers of those investments, and especially over the last 2 years. So already in summer 21, we saw the decline in venture capital or in the valuation of venture capital investments, because we saw it in our database. We saw that the valuations are going down for several reasons. One important reason were the rising interest rates. Of course, this has an immediate impact on the valuation of venture capital investments. It has a less important impact on the valuation of buyout investments. So we have seen that already in 21. and it was not a surprise to us because that's what you would have expected from from a diversified global venture capital portfolio when you see this environment. Very interesting number is also the volatility. You see a very low volatility of roughly 6% for buyout and 8.5% for venture. Again, this is an annualized figure over the past 10 years. And as you would expect, because we are talking here about the book value performance, about the NAV performance, this is a very low volatility number. It shouldn't be a surprise. For the stock price indices, the volatility is much higher, but because we're looking at fundamental data, you would expect a much lower volatility figure than for the stock price performance. And of course, this is reflecting the underlying investment activity. However, when you look at the stock price performance, you will see a volatility number, a risk number that is significantly higher than what you see here. The question is, how do you want to use that data? How do you compare your performance data, and how do you include that data in any tool, reporting tool, asset allocation tool that you use to measure your performance in private equity against a broad market? This is the sector allocation of the main private equity index, and it shows you that you have a very diversified portfolio, diversified across sector allocations, across regions, investment styles. So when you look, or when you make the look through the investment portfolio, you will realize that you have a very diversified and broad investment portfolio reflecting roughly 6,000 investments, in direct investments and indirect investments. In this case, indirect means fund investment, so there can be some investments into private equity funds. But as you can see, the main investments are direct investments in unquoted companies from the balance sheet. When we have a look at the vintage year distribution, again, here is what we could expect from a diversified portfolio. You have a diversified distribution in vintage years over the past years. Again, this is what you would expect from a diversified portfolio, so not a surprise here, but just to show you some of the characteristics of the index, and then an investor can analyze whether this reflects his investment portfolio or not. Of course, if someone is invested in just one vintage year, let's say 2021 or 2020, and has no other investments in private equity, then this benchmark would probably not be appropriate because we have, by definition, a diversified portfolio in the indices. Another topic that I would like to talk about today is the so-called currency ignorance. What we realize in many other data sets and performance numbers is that it's still not uncommon that you simply add performance numbers in different currencies. So let's assume you have a fund in US dollars, and then you make investments in the UK and in Canada. Then you have, of course, you have Canadian dollar, you have British pounds. Then you should, in theory, convert those performance numbers to one currency. However, what we see in many cases is that it's just added. So you add performance numbers in pound and in Canadian dollars, and then aggregate this without reflecting or without taking into account currency conversion. And what does this mean? This means that you are not correctly measuring the performance of a private equity fund. And of course, then you are not able to compare those performance numbers with a private equity portfolio that is just investing into one currency. And in order to measure this or to give you an impression what that could mean in the long term, what I have prepared here is just to compare two versions of our stock price index in this case. I've used the stock price index of our broad private equity fund because then you can apply the hedging methodologies that you usually apply when hedging a portfolio of equity investments. It's very easy to apply a hedging strategy here. It's not that easy with a typical private equity fund, but what I wanted to do here is to give you an impression of what currency or how currency can impact the performance of a global broad private equity portfolio. So you see here on the one hand side, you see in dark blue the hedged version of a broad private equity index. In this case, I use the LPX 50, and the other line gives you the unhedged version. So let's assume an investor would like to hedge out currency risks. So he wants to have the performance numbers in his home currency, in this case in euros. So he would lose almost 2.9% every year over the past 10 years. So that means that you should expect hedging costs in the region of roughly 3% every year when you would like to have a portfolio that is hedged. Of course, this requires that the underlying investments are all reported in the same currency or are converted to the same currency. But yeah, you can see here from this chart that quantifying the currency impact is very, very important. It can have a very significant impact. And if you just add performance numbers, yeah, you simply cannot compare this and cannot draw any meaningful implication from that. And of course, you cannot do any hedging on that when the underlying currency exposure is not known or is calculated in a way that it simply cannot be used for performance reasons. So this is just something I would like to show you on the currency side, because I think it's very important to have a look on that. And as I mentioned, what I currently see in many data sets is simply ignored or treated in a way that you should not treat it. So yeah, would like to draw a little bit attention to that and just show you how important it is to have an understanding of the underlying currencies that you are exposed to. Last but not least, a few words on our premium discount index, because what I mentioned on the invitation is also that we have a tool that helps you to analyze the pricing and valuations in the secondary market and to get basically a second opinion on that, because that's by definition a second opinion, because this reflects supply and demand of private equity portfolios that are traded on the stock exchange. And as mentioned before, when you have a stock price that is above its book value, they have a premium, and then when it's below the book value, you have a discount. And for the private equity market, this is a very important figure because it gives you the sentiment in the market. And here you see the premium discount index for more than 20 for the past 20 years. You see we had very high premiums of up to 20% before 2007. Then we had financial crisis. Over the past years, we mainly have seen discounts in the market. So many investors have the impression private equity companies only trade at a discount. However, this is not true, as you can see here from this chart. It was true over the past 10 years, but that's not a given. So there can be circumstances where private equity companies also trade at a premium. Now the question is how can you use that data? Again, here we have daily data, so you get a daily update on the investment portfolio level. You get a daily update on the premium discount on the valuation of that private equity portfolio. And then you can use this information to analyze whether a diversified portfolio of secondary investments is measured fairly or not. And again, here we have it not only for the global and broad market, we also have it for buyout, we have it for venture, we have it also for private debt investments. So there is a whole universe of data that you can use to analyze or to get a second opinion on pricing in the secondary market. Yeah, so that's already it for today. So yeah, if you have any questions, yeah, please feel free to contact me directly, drop me an email, call me. So I'm always happy to answer any questions you might have. And yeah, that's it for today. I'm really looking forward to our next webinar, and yeah, would like to thank you for your time.